Hello, in this presentation we will record a transaction related to the issuance of an invoice for an item that had been pre-ordered and listed for a certain customer on the purchase order into our bookkeeping system within Excel. We're going to keep in mind how that same process would be done in accounting software such as QuickBooks. If you would like more information about the QuickBooks Pro, take a look at our comprehensive course in the link below. We're going to first look at QuickBooks and see how this might be entered into accounting software such as QuickBooks and then enter that information into Excel. We're going to start off with the creation of an invoice. In essence, what we're saying here is that we already had a purchase order that was created, meaning we issued a purchase order to the vendor requesting a piece of inventory, in this case a guitar. However, the purchase order isn't just for any guitar, meaning it's not just to stock our shelves. We actually listed within the purchase order that we want this particular item for a particular customer. And that's something we can do within the accounting software oftentimes, and that makes the creation of the invoice a little bit easier sometimes by tying out that specific purchase, taking that information from the purchase order that we used in order to order the information, and populating the invoice with it. Oftentimes, if this was the case, if we had someone come into our shop and say they want this specific guitar, which we don't have in the shop at this point, and we then were going to order for it, we may get a security deposit, a deposit from the customer, and then order the guitar. We'll talk more about a security deposit later. In this case, we're just basically assuming that we have made a purchase order from a vendor for a specific customer, naming that customer in the accounting software, and now recording the invoice where we're going to bill the customer for the delivery of that guitar to that specific customer. So we're going to put in the customer name. The customer name is for the invoice is going to be Eric Music if we were to record this on the accounting software. Once we enter that data, we may get something saying select the outstanding billable time. It's going to say, hey, that customer has something that is outstanding related to that customer, and we can go then and select that information. In this case, it's going to be an item that will be outstanding. We're going to go through and it's going to say, hey, there's an inventory item here that is outstanding, and it's tying that out to the purchase order that we had prior made. And by clicking this, by tying those two out within the software will be able to use that information from the purchase order to automatically populate the invoice. So now we have the invoice automatically populated, and all we had to do was basically type in the name and say, yeah, there's an outstanding item. That's it. That's the one we want. That's the one we want to invoice, that guitar, which we're going to be shipping to the customer. So that populates, we have the date here, then it just populates the item, which is the inventory item, in this case an ELP. The quantity was 1. All this will populate automatically once we have the item, the ELP, in there, which is an Epiphone Les Paul. It's going to be a type of guitar. The amount is 500, and that's going to be the total of 500. And all this would calculate for us. Then it's also going to add the sales tax because we are selling inventory in a location where sales tax is required. So we're taking that 500 times 5% and owing sales tax of 25. Giving us the total of 525. If we were, this is all populated here. It's pretty easy input screen that we can see on this system. It's a lot more going on though in terms of the financial statements, in terms of the transaction once we enter an invoice. So the invoice then, the invoice means, remember, that we have in essence done the job, earned the revenue, and it's going to record a receivable. The invoice means accounts receivable in essence is going up. So we're going to increase the receivable by the full amount that we are owed, the amount we expect to receive in the mail. We're going to credit then what we have earned. That's the sticker price. That's what we charged for it. That's the 500. Then we have to credit as well for the amount that we are going to receive from the customer that we don't get to keep but have to pay in format of a liability to the state. That's the 25 sales tax. We also have the related cost of goods sold that is recorded with the generation of this invoice, something that's not even input into the screen, something that the computer system knows if this item was set up properly, and it will then decrease the inventory on our books in an average cost system method, and it will record the related cost of goods sold we will record this process now in QuickBooks and see, I'm in Excel, and see the detail of it. Here we are in Excel. We're going to record this transaction. Now note that although this was a pre-ordered item, it's not something when we had the purchase order. The purchase order is something that doesn't typically have a financial transaction. So we didn't record the purchase order here, and we don't then get to be able to really easily connect the purchase order to the invoice and have it auto-populate for us and all that. We're basically just going to have to enter the invoice at this point in time as we issue it, as we would with a typical invoice when we record this process. So when we record the invoice, we're going to say first, is cash affected? We're going to say no, cash isn't affected. If this was a book problem, the invoice, the book terminology for something like an invoice, the transaction related to an invoice is something like we made a sale on account. We sold inventory on account. We didn't receive money yet. We got an IOU. We got accounts receivable. So accounts receivable is going to go up. Accounts receivable is a debit balance account. We are going to increase it by doing the same thing to it, which in this case is another debit. So I'm going to copy the accounts receivable. We're going to scroll down to a new area. The date then is going to be 1/25. We're going to put the accounts receivable on top, debiting it in cell L20, right click, paste 123. Amount then will be, for the full amount, the $500 plus the sales tax. So if we were to calculate this out, then of course we'd say it's the sticker price that we would have, which was the $500, and then we'd have to calculate the sales tax on top of the $500 times 0.05. That would give us the 25. If we add that then to the original 500, that'll give us 525. It's also useful to know that we could calculate that by saying 500 times 105% times 1, the full 500, 0.05, another 5% sales tax to get that 125. So we'll go ahead and do that. This would be on the sticker price. If we had a store and we imagine the guitar there, we can see that we would have the 500, and then we'd have to charge the sales tax times 1.05 is what we would then record the item for that we will be receiving. That's the receivable. The other side then is typically the revenue. We typically record revenue when we make a sale on account, when we issue an invoice. The revenue accounts are down here. It's in order: assets, liability, equity, and then revenue. We have 3 revenue accounts. We are recording sales revenue or merchandise sales. Revenue always has a credit balance, and it typically only goes up, meaning we only increase revenue. Customers only pay us. We don't pay customers. When we do, we usually have an expense or some kind of contra sales account, like a return or an allowance. So we're going to credit this. So I'm going to copy the merchandise sales. We're going to put that underneath in L21 and right click and paste 123. We're not going to credit for the 525, however. We're just going to credit for the sticker price, which was 500. That's the amount that we earned. That's the amount we get to keep. The difference, 525 minus 500, or 500 times 0.25, is the amount that we have to pay for the sales tax. I'm going to use our plug formula, the negative sum formula, in order to figure that out. So I'm going to say negative SUM, and then select the sum and highlight these 4 cells and enter. So there's a 25. You could just put a negative 25 to put that in there, but I like that formula because it's useful when we get to, if you're using long, complicated formats or formulas, it'll just plug that number in. If we highlight the whole thing, then of course we are at 0. Debits minus the credits equals 0. This amount represents what is owed to the state for the sales tax we collected of this 525, the 25 of it. Therefore, it's going to go to the payable, sales tax payable. So I'm going to copy sales tax payable. We're going to put that in cell L22, right click and paste 123. And then you're going to highlight the 2 credited amounts. Going to format them, go into the Home tab, Alignment, and increase the indentation. And there's going to be the first part of our journal entry. We're also going to have to record the decrease in the inventory and the related cost of goods sold. And we're going to record that in a separate transaction. Remember that QuickBooks or any accounting software will typically record them all at one time, putting all debits on top, credits on the bottom. It's easier to see if we break them out. Most textbooks will break them out. And that's the difference if we are doing the work versus a computer doing the work. We want to put it in a format that best suits us to go back and see. The computer's going to go apply a bunch of rules, of course, which is that this all happened at the same time. It's the same transaction. The debits go on top, credits go on the bottom. So keep that in mind as you record this. You need to be able to see it in the computer, and we need to be able to build it to best go back to it ourselves, as well as explain it to other people when we're doing it outside of a computer or in software such as Excel. So now we're going to record this. We're going to go to the receivables. The receivables up here is the second account on the trial balance, and therefore the second account on the general ledger. Before we record that, we're going to freeze the panes. So we're going to put our cursor in AJ1. We're going to go up to the View tab. We'll go to the Windows group, and we'll select Freeze Panes and Freeze Panes. We're then going to go over to the accounts receivable. So here's the accounts receivable. Oh, it didn't freeze. I think I unfroze the panes. Let's do that one more time. We'll go to the AJ1, the View, Freeze Panes, and Freeze Panes. All right, scrolling back over. We're in the accounts receivable. Scrolling down, we need to be in the debit side of it. So I'm in cell AQ14. AQ14, we'll select equals, point to the 525, increasing the 830 balance by 525 to 1,355. That 1,355 then also found on the trial balance here, 1,355. Scrolling down, we also need to record the sales, and that's our income account. Remember, it's in order: assets, liabilities, equity, income. Here's the merchandise. It's going to be our first dark blue account, the first income account, the first revenue account on the trial balance, and therefore the same on the general ledger. So we're scrolling. I'm just going right, scrolling right until we find the merchandise account right there. Notice all we see are credits, because that's all it does. It goes up in the credit direction because it's revenue, income. And we're going to say in cell BH25 equals, we're going to point to that 500, bringing the 1,190 up by 500 to 1,690. Scrolling back over to the trial balance, we'll see that same number, 1,690 on the trial balance. Then we're going to record the sales tax payable. Here it is on the journal entry. Here it is on the trial balance. It's going to be in the same location in the general ledger. So we're looking for those orange accounts. Let's go to the green accounts, which are asset accounts. And then it's going to go to the orange accounts, which are liability accounts. And we're looking for that sales tax payable. So I'm going to scroll down. I think I see it there. There it is in BD 28. We'll select equals and then point to that 25 sales tax payable, bringing the liability up in the credit direction to 85. Scrolling back to our journal entry, that 85 is here, and we are back in balance there. Note that net income went up because merchandise income went up. Those credits are now beating the debits. Credits minus the debits are at 946. We're not quite done here, however, because we got the accounts receivable, and remember, we record the accounts receivable here. That's what people owe us. If we want to see more detail on that, like all accounts, we can see the detail by when things happened in the general ledger. But we also want to know who owes us money, and therefore we will track this in a subsidiary ledger as well. So we're going to scroll all the way to the right and put the same information into the subsidiary ledger, meaning this is kind of like another general ledger. It's just going to be in order by customer rather than just by date. So if we scroll all the way over to the columns CR, we'll see this accounts receivable subsidiary ledger, which is where we want to be. And we're going to scroll down to the accounts receivable 525, and that's from, it says Eric Music. This is from the data in our PowerPoint. So Eric Music is the one here, and that's going to be a new customer. So we're going to add Eric as a new customer, and we're going to put that same entry right here. We're going to say that owes us 525. So I'm going to say that equals that same 525 that we recorded to the general ledger. This in essence is another kind of ledger, another kind of general ledger, just in a separate format called the subsidiary ledger for the customers. So if we see that, we're at 1,355. Note that in QuickBooks, of course, the QuickBooks can format this ledger in a lot of different ways. They can age it by customer. They might just call it a customer balance account, a customer balance detail account. But in essence, we're breaking out the information by customer and seeing which customers make up that 1,355. So this is the amount then that should be on the trial balance. So double check that, and the general ledger, 1,355. I'm just scrolling back over to the general ledger, and there's the accounts receivable, 1,355 there. Scrolling back over to the trial balance, there's the 1,355 there. Next, we're going to record the second piece of this, and that's the fact that we gave up inventory. We sold, in this case, an ELP, an Epiphone Les Paul guitar. That's got to go down, and record the related cost of goods sold for that guitar that we sold. Now, the sticker price gave us the amount of $500, which we recorded sales tax on it, but it doesn't give us the cost. For that, we got to go to our cost worksheet and see what an ELP cost us to purchase. So we're going to scroll back over and notice that I'm going to keep going right as I do. I'll talk through this. Notice that we're using a perpetual inventory system. We are recording the cost of goods sold and the reduction in inventory as we go. Now we're looking for an ELP. So here is the ELP. It's going to be the first item, and we sold this on 125. So we're going to say in the cost of sales, let's skip another line. I'm going to put this down here in CE8. That's because I need to have this line open. So we're going to be 125. I'm going to be in the cost of sales. I'm going to scroll over a little bit more. We're going to be in this cell. And what we're going to say is we have two of these, and there's an average cost of 400. So they all cost about 400. They all cost 400 because they all cost that. But also, if these costs were different, we would have an average of about 400. So, and then we're going to say that we sold one of those two in the cost of goods sold section, and it cost 400. And therefore, the cost of goods sold we will be recording will equal 1 unit times 400. This is what we're going to record in the cost of goods sold. This is what should be left in ending inventory. We need to fix now what is left in ending inventory in our system. So we're going to say that we had one, we sold one, there's one left. I'm going to use the formula to do that by saying equals, this is what we had, minus the one we sold, gives us one left. I'm just going to say equals the 400 is what they cost, and then multiply that out, 1 times 400, which is obviously 400, equals 1 times 400, and that is 400. Then we're going to scroll down and say that we have to fix this formula down here. This imperfect formula, just adding up all the end totals. It's adding up all the end totals. And if I scroll up, I just double clicked on it, by the way, to see the highlighted. It's adding up the 800. I need to bring it down to the 400. If we look in the formula, we see that it's P7, and I need it to be P8 now. So I could just go here and say that 7 needs to be an 8, and then it'll move it down. If that's confusing, we can delete this and just say, I'm just going to redo this, say equals, and I'm just going to point and add every cell I want. Of this first guitars, I want the last number, that 400, plus, there's the plus, that 480, plus, the 440, plus, the 0, plus, the 304, plus, the 320, plus, the 598, and enter. There's the 2542. This is the amount that should hopefully be on the financial statements, on the trial balance, on the general ledger after we record the second piece of our journal entry. So that's what we'll do now. We'll record the second piece of our journal entry. I'm going to scroll up. Remember that we are just going to record the sale of the cost of goods sold piece of the sale of the inventory at $400. We're going to scroll back over to our journal entry, scrolling back over to the journal entry. Just holding down the left arrow all the way back. And we're going to say that this inventory now is going to go down by, now we know, $400. So inventory has a debit balance. We're going to do the opposite thing to it in order to make it go down, which in this case is a credit. So we will copy the inventory assets account. We're going to put the amount of 125. We're going to put this underneath in cell L25, right click and paste 123. And the amount will be in N25, a negative 400. We're then going to debit 400, so I'm going to say negative of that number. And then the amount is going to be, the last account is going to be the cost of goods sold. That is the expense of us consuming the inventory in order to help us generate revenue. Now, expenses always have debit balances. We already know we're going to debit it because we decreased the asset, but if we think about it, we'd say that expenses only go up in the debit direction typically, and we are going to increase it once again by doing the same thing to it, which in this case is another debit. So we will copy this. Going to put this on top in L24, right click and paste 123. Then I'm going to indent this second cell. I'm going to put my cursor on L25, Home tab, Alignment, Increase Indentation. There we have it. Now this is our journal entry we journalized in the general journal. We will now post that to the general ledger, starting with cost of goods sold. It's way down here. Remember, it's in order assets, liabilities, equity, income, and expense on the trial balance, same order on the general ledger. So we're looking for those dark blue accounts as we scroll right. Scrolling right, looking for the dark blue, we got assets, then orange liabilities, then the income statement, and then we have the merchandise. There's the cost of goods sold. And notice we only have debits here because cost of goods sold typically only goes up in the debit direction as expenses do. And we are in BK25. We're going to select equals and then point to that 400, increasing the 952 balance by 400 to 1052. Scrolling back over to the trial balance, just holding down the left arrow, we're out of balance by the 400, and this has gone up to 1,352 in the cost of goods sold. Net income now is increased by this 500 from the first transaction, and then increased the expense, which decreases net income, by that 400. So that's going to be the effect on the income statement. We're currently at income, which is a credit balance of 546. And we have the asset of 400 that is the inventory asset that was recorded here. We're out of balance by 400 until we record this inventory asset. So let's do that now. Inventory asset is going to be the third account on the trial balance, and therefore the third account on the general ledger. Scrolling over to the general ledger. Scrolling down, we have the inventory asset. We are in cell AR30. So AR30, we're going to select equals and point to that 400, bringing the balance of 2,943 down by 400 to 2,543. That 2,543 then should also be found on the trial balance. There's the inventory asset, 2,543. We are back in balance down here. And we should also be able to find that 2,543, remember, is what our balance should be in the sub account, breaking this number down by item. Let's check that out again. We're going to go back over 2000, let's remember that number. 2,543, scroll in right. 2,543, 2,543. Here's our account we started with. Scrolling down, we're at 2,542. It's off by $1 because of rounding. So this is going to break, so that's okay. So this is going to break out our balance sheet account by inventory item. Each of these inventory items, this is what we need in order to track, the cost of the items that we're selling. So that's going to be that. If we scroll all the way back over, then we'll do one more check. Going all the way back over, we'll see what happens to the financial statements. We're going to unfreeze the frames by going to the view. We're going to go to the windows and freeze panes and unfreeze the panes. And then we did something to, in this case, the inventory assets. So we're going to check out what happened to the financials. We did something to the accounts receivable. We'll check out what happens to the financials. We did something to the merchandise sales. We'll see what happens to the financials. We did something to cost of goods sold. All that is going to be automatically updated on the financials due to just the automation, the formulas, in a similar way as it can be done in the financial statements. Scrolling back over, we see that the accounts receivable has been adjusted, inventory assets, total assets are at the 239.28, equaling liabilities and equity. The income statement, revenue has gone up, as has the cost of goods sold, and therefore gross profit. No other expense here, so net income is the same as gross profit. And the statement of equity includes that net income number, resulting in an ending equity of $159.43. That same amount on the balance sheet, $159.43.